Hey, I'm Sydney Kirkland, and we're part of the NextGen company, and we're here today to teach you about the accounting cycle. So, what do you guys know about accounting?
Well, I'm pretty sure it involves money.
Okay, there are 9 steps to the accounting cycle. First, we have analyzing transactions. Secondly, we have journalizing transactions. The third step is to post the transactions to the general journal. Fourth, we're going to prepare an unadjusted trial balance. Step 5, we're going to make adjustments. 6, we're going to prepare an adjusted trial balance. 7, we're going to prepare the financial statements. 8, we're going to close temporary accounts. And then the last step is to prepare a post-closing trial balance. Okay, before we talk more about the accounting cycle, we have to clear up some misconceptions. Myth number 1, debits equal decrease, credits equal increase. Debit does not always equal decrease, and credits do not always equal increase. We'll talk more about that later. The second misconception is that accounting is all about math. The most math we'll do in this class or during this workshop is multiplying, dividing, adding, and subtracting. Myth number 3, accounting is insignificant in business. Accounting has been claimed to be the language of business. It explains the how and why of business functioning, and it keeps records of business transactions.
I was just wondering, how do you think the myths came about for accounting?
That is a great question. The myths come about, when people don't truly understand the accounting process, and then they tell someone who then truly doesn't understand it, and word of mouth spreads. But hey, today we're here to get rid of all the myths, and you'll know.
So, I'm going to begin with talking about the generally accepted accounting principles known as the GAAP. The first one is the cost principle, which is cash has to equal your service. So if someone walks into Gmaw's ice cream parlor and asks for $6 worth of ice cream, then you have to have that $6 worth of cash back. The revenue recognition principle is to recognize revenue when it is earned. So if someone comes in and buys something, then we're going to recognize that revenue. The matching principle is you have to spend money in order to make money. So we have to buy our gallons of ice cream in order to be able to sell the ice cream to our customers. The full disclosure principle is we have here no sneaky business. That means that everyone should be able to access your financial accounts. So that way, if a company is making too much than they need to make, then we should be able to see where their transactions are coming from.
Are you guys ready to learn more about the accounting cycle?
Yeah!
Absolutely.
Step 1, analyzing transactions. So, this is our transaction. So on January 12th, Annie comes into Gmaw's Sweet Tooth Ice Cream Parlor and purchases $150 worth of ice cream. So because she made a purchase and she received her ice cream, we know we can recognize revenue. So one revenue account is sales for $150. And since she paid, our other account is cash.
And then credit is money that you can borrow but you pay back.
So before we can generalize our entries, we have to understand a little bit about what a debit and a credit is. Debits and credits represent the normal side of an account. And on that normal side, whether it's a debit or credit, that's the side you would use to increase that account. So for cash is increasing. Cash has a normal balance of a debit. So we write cash on top. And our 150 on the debit side. Now sales go up, but sales have a normal balance of credit. So you write it as a credit. And in your journal, you always indent to show credits.
So what you're saying is that debits aren't about how much you decrease, increase, but debiting and crediting is based on the normal balance side of an account.
Correct.
If you're not sure if the normal balance is a debit or a credit, refer back to your chart of accounts, and that will tell you. Step number 3 is post your entries to T accounts, and this is what a T account is because it's shaped like a T. So on the top, you have your account name. On the left side, your debit. The right, your credit. And this is used to keep a running total of all your transactions in one account. So your sales, credited 150. So you put it on the right side. Credit. Cash, debit 150. That's just like that.
Okay, so step 4, we're going to prepare an unadjusted trial balance. And an unadjusted trial balance lists all the accounts affected during the business transactions. So we have the sales and cash from step 3, and we're going to list the account names right here. Along with their debit and credit balance. So as you recall, the debit is the left side and the credit is the right side. So sales, we're literally gonna take the information from the T account and post it to the trial balance. So sales was a credit, so over here, 150 credit. Cash was $150 debit, $150 debit. And then you can take the total, so the total credits is 150. The total debits is 150.
Adjustments. Now, before we get to adjustments, you have to understand why we adjust. There are two forms of accounting, accrual-based accounting and cash-based accounting. In the accrual-based accounting, you recognize cash when it's earned and expenses when they incur, when they happen. Cash-based accounting, you recognize cash when it's received and expenses when they're paid. GMA, along with basically all other companies, except for a few, use accrual-based accounting. So that's why we have adjustments to make sure it's accrued. Just made that word up. So, our adjustment. GMA had $40 of ice cream inventory, and then when she counted, she only had $20 left. So this means you have to have 40 when she started, minus the 20 she has now, means she has $20, means she lost $20. So you must make an adjustment to inventory expense. And you debit it because it's going up, and debit's the normal balance for an expense, and you must credit inventory, which shows a decrease because debit is the normal side for inventory. This shows that we have $20 less worth of ice cream, and that ice cream inventory turned into an expense.
Okay, so step 6, we're going to make an adjusted trial balance. So remember in the last step we had a $40 beginning inventory of $40. The $40 credit of cash explains how we got the $40 inventory. So I know we didn't go over that, but I'm explaining that right now. So as you can see, the debits and the credits remain in balance. So to make the adjustments on the trial balance, we just take